Welcome back to Investing Talk Podcast.
Today we're looking at Kodiak AI. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Kodiak AI, they're really positioning themselves, aren't they? Trying to be indispensable in this whole logistics transformation.
Yeah, the narrative is all about that proprietary Kodiak driver platform. It feels like a winner-take-all software race.
That's the core thesis, basically. If they win that race, they could dominate the market.
And Wall Street seems to be buying into that potential. I mean, the momentum is huge right now. Analysts are definitely piling in.
Oh, yeah. What have we seen there?
Well, Zacks moved to hold, which is, cautious. But then you've got Cantor Fitzgerald upgrading KDK to strong buy.
Okay, that's bullish.
And even more recently, just this month, October 2025, Citi jumped in, initiated coverage with a straight buy.
Right, so quite a bit of positive sentiment there. If you boil all that down, what's the consensus?
It's a strong buy rating overall. And the price target they've landed on is pretty attractive, $13.25 for the next 12 months.
$13.25. And where's the stock trading now? Mid-October?
Around $8.70, give or take. So yeah, do the math. That target implies something like 52% upside.
Wow, okay. 52% potential. That definitely explains why the growth-focused investors are interested.
Absolutely. That's the kind of number that gets attention.
But, a price target is one thing. Is the chart actually backing that up? Is there technical support for this? Or is it just, analyst optimism?
That's a fair question. And actually, the technicals look surprisingly solid right now, especially for a name that can be, let's face it, pretty choppy.
How so?
Well, the stock's up about 17% in just the last month. It looks like it's built a pretty nice base, a bullish structure, after getting knocked down earlier in the year.
Okay, establishing support.
Exactly. It looks like what traders call an accumulation pattern. Right. Suggests bigger players might be stepping in.
Right, the strong hands providing a floor, maybe. What about the moving averages?
That's the encouraging part. All the key ones, the 10-day, 50-day, even the 200-day, they're all sitting below the current price.
Ah, okay. So the price is holding above those longer-term trend lines. That's generally seen as a technical buy signal, isn't it?
It is. It suggests the stock has strength and support underneath it.
And what are the key levels people should be watching? Like resistance and support.
Good point. Support seems pretty solid around the $8 mark. It's held up okay. Immediate resistance is right near $9.
$9, okay.
But the really big one, the level that could unlock more upside, is nearer to $10.48 if it can decisively break through that.
Then the path towards that $13.25 target looks a lot clearer on the chart.
Exactly. The technical picture clears up significantly above that $10.48 level.
Okay, so technically strong, analysts love, big upside target. That sounds pretty compelling.
It does. It really does. But we absolutely have to pause here because before anyone gets too carried away by the chart, let's talk financials.
Yes. The dose of reality.
Pretty much, because this is where the story takes, a dramatic turn. The numbers are kind of shocking.
Okay, let's hear them. It's typical for these early-stage AV tech plays, though, right? High hopes, high burn.
Extremely high burn. So trailing 12 months TTM, ending June 30th, 2025, revenue was only $16.08 million.
$16 million. Okay. I mean, it's revenue, which is good, shows some traction.
It does show growth, yes. But compare that to the losses. The TTM net loss, wait for it, $275.41 million.
$275 million loss on $16 million revenue.
Oof.
Yeah.
That works out to a net profit margin of minus 1,712%, negative 1,712%.
And that number, it sounds absolutely terrifying, I know. But for you listening, you really need the context here.
Explain that context, because it looks bad on the surface.
It does. But this isn't necessarily a sign the business is failing. It's the cost of trying to win this market. It's strategic spending.
So they're deliberately losing money hand over fist.
Pretty much, yes. Think of it like you said earlier, a high-stakes R&D race. For every dollar they're bringing in from those early truck deployments, they're spending, what, $17?
Over $17, yeah.
Right, spending it on refining the platform, safety, mapping, scaling up. This kind of operational loss is actually typical for these AV innovators at this stage. Profitability comes way, way later. The priority now is market share and tech leadership.
So it really is a land grab funded by investor cash.
Precisely.
Yeah.
And the market's willing to fund it, for now anyway. Their market cap is still pretty robust, around $1.5, $1.6 billion.
Which is decent for this stage.
It is. But That huge cash burn rate, it means they need the capital markets. They're dependent on being able to raise more money.
Which brings in dilution risk. If things slow down, they issue more stock, existing shareholders own less.
Exactly. That risk is always there. It's ongoing. They need that cash flow from investors until the actual trucking operations can start paying the bills, basically.
Okay, so given that valuation, which is clearly speculative, and the massive burn rate, everything really hinges on what happens next, right? Near-term events.
Absolutely. The investment case relies heavily on upcoming catalysts justifying the current price.
What's the biggest one? What's the pivot point everyone's watching?
There's one date circled on everyone's calendar, November 12th, 2025. That's the Q3 earnings release.
Earnings. Always crucial.
Hugely crucial for KDK right now. The entire market is laser-focused on getting confirmation of improved operating metrics.
What specifically? What do investors need to see on November 12th to feel better?
Concrete stuff. They need evidence that commercial deployments are accelerating, not just tests, but real trucks running real routes for customers. And crucially, that those operations are starting to generate meaningful revenue.
So signs that the R&D spend is actually starting to translate into a scalable business.
Exactly. The volatility around this earnings date could be extreme. If they deliver strong customer wins, show that path towards justifying the spend, the stock could really move up.
And if they miss, or if the commentary is cautious about the ramp up,
then the correction could be just as sharp downwards. It's a high-stakes release, no doubt.
Okay, so earnings are number one. What else? Any market-driven things happening?
Yeah, beyond just the company's execution, there are capital flow catalysts. Think about the institutional money. The 13F filings are due around December 20th.
Right, where the big funds have to disclose their holdings.
Exactly. And remember, back in September, there were those reports, maybe rumors, that big names like George Soros's fund were increasing their stakes.
I remember that chatter, yeah.
So these December filings will be a big reveal. It's like a referendum on institutional confidence. If we see major funds were still buying KDK in Q3, despite the losses, that sends a powerful signal.
Kind of like the smart money showing their hand. Makes sense. What else?
Then there's the whole passive investing angle. Money that flows in almost automatically.
Like ETFs.
Precisely. We're looking at potential ETF rebalancing around December 2nd, especially those thematic ETFs focused on AI, robotics, autonomy.
And there are rumors KDK might get included in some of those.
That's the chatter. Index inclusion. If KDK gets added to a major AI or autonomy ETF basket,
then all the funds tracking that index have to buy the stock, right? Regardless of the earnings report or anything else.
Exactly. It's mandated buying, guaranteed passive capital flow. That can be a real momentum booster, totally separate from the company's fundamentals. Traders watch that stuff very closely.
Okay, interesting. Now, let's wade into the murkier waters. Speculation. Rumors. Stuff that definitely moves the needle for retail traders, even if it's unconfirmed.
Right, and we should stress this is speculation.
Yeah.
But it's part of the trading narrative, so we have to mention it. What's out there?
Well, first, there's always talk of an imminent strategic partnership, like KDK teaming up with a major truck manufacturer, an OEM, or a huge logistics company.
That would be big. Instant validation, potentially faster rollout.
Makes sense strategically too, right? A legacy player wanting to bolt on KDK's tech.
Definitely. Then there's the regulatory angle. Chatter about some kind of AI legislation breakthrough.
Hoping the government suddenly makes it easier to deploy autonomous trucks everywhere.
Pretty much. If regulators approve broader deployment across states faster than expected, boom, KDK's potential market size explodes overnight. The market loves to front-run that kind of news.
Even if it usually takes way longer in reality.
Always. And finally, the really speculative stuff. Takeover talk. Maybe a big tech giant wants to buy them. Or even talk of a share buyback program.
A buyback would signal massive confidence from the company itself, but feels unlikely given the cash burn. Still, like you said, it's part of the narrative.
It is. And all this speculation, all this potential, it brings us squarely back to the risks, which are significant.
Yeah, let's be clear. This stock is not for everyone. The volatility alone.
It's intense. The average weekly move is, what, 13.6%?
13.6%. That's huge compared to the broader market or even the sector averages. When this thing moves, up or down, it really moves.
Means you need a strong stomach. And probably tight risk management if you're trading it.
Definitely. Beyond just the price swings, though, what's the core risk?
I think it boils down to execution risk. Pure and simple. Can they actually deliver?
Deliver the technology safely, reliably.
And crucially, can they scale it? and prove it provides a clear return on investment and ROI that beats using human drivers in the current system. They have to do that and do it relatively quickly.
Otherwise, the whole financial story just doesn't hold up.
Exactly. If the deployment stumbles or the economics don't work out in practice, that thesis collapses fast.
And the other big elephant in the room, regulation.
Oh, yeah. Regulatory uncertainty. Imagine trying to run a fleet across, dozens of states, and each one has slightly different rules on liability, insurance, where and when the trucks can operate.
It sounds like a nightmare.
It's a massive headache. And honestly, that regulatory patchwork might be a bigger bottleneck to scaling than the tech itself right now. The whole sector depends on how fast and how favorably regulators act across North America.
And that's notoriously slow and unpredictable. It's the real wild card.
Absolutely.
Okay, so pulling it all together for you, the listener, where does this leave us on Kodiak AI right now? You've got this incredible technical momentum, really positive analyst targets pointing to big upside.
Plus those near-term catalysts, especially the make-or-break Q3 earnings on November 12th. Lots of potential excitement there.
But that excitement is running headfirst into some pretty stark realities. The shocking financial losses, the high cash burn rate.
And those very real execution and regulatory risks we just talked about. It's a balancing act.
So who is KDK right for?
Well, you could argue it's attractive for a couple of different profiles right now. Tactical traders might look to play the volatility around those Q4 catalysts, especially earnings.
High risk, high reward kind of trade.
Definitely. And then there are the long-term investors. The ones betting on the whole autonomous trucking revolution, the transformation of logistics over the next 5-10 years.
For them, it's about whether KDK can emerge as a leader in that massive secular shift.
Exactly. But even for them, the near term matters. The central question really comes back to November 12th. Will the commercial growth they hopefully announce be strong enough to start justifying this current very high valuation?
Or will it look like they still need a lot more cash before they get anywhere near sustainable profitability? That ramp-up speed, it feels like everything hangs on that right now. It's the difference between being an industry game changer or just a very expensive R&D project.